Hello, and welcome to HWM Investment. This analysis is for Howmet Aerospace on the New York Stock Exchange as of 7th of August 2026 with a share price of $289. The full report is on HWM.ca. At $289.72, Howmet is an elite aerospace compounder, near sole source flight critical engine parts, quality 83, a strong driver. Q2 reconfirmed the upcycle with revenue more than 24% and EPS more than 33%, but it still trades approximately 62 times earnings against the approximately 22 times warranted multiple, 2.80 times, deep expensive, hold on every horizon, a great business at a rich price. Howmet Aerospace, built from the former Arconic, makes highly engineered metal components for aerospace and transport. It runs four businesses: engine products, the turbine airfoils and rings inside jet engines, aerospace fastening systems, engineered titanium structures and forgings, and forged aluminium truck wheels. What sets it apart is a near sole source position on flight-critical, spec-certified castings and forgings that are extraordinarily hard to qualify a second supplier for, which gives durable pricing power and a rich recurring engine spares stream. Think of it as a high-moat picks and shovel supplier levered to the commercial aerospace upcycle and defense. Quality scores 83, the driver 76, and second quarter revenue grew 24%, with earnings up 33%. The valuation is where an excellent business becomes only a hold. Howmet trades near 62 times trailing earnings against a warranted multiple of about 22, a ratio of 2.8 times, deep in the expensive band. That ratio actually eased from July's 3.03, but only because earnings grew into the price after a strong Q2. The multiple itself is still extreme. The valuation pillar scores just 38. At today's price, the market embeds low 20% sustained earnings growth. Our disciplined estimate is mid-teens. The cushion is thin, a free cash flow yield of about 1.7% and a price-earnings to growth ratio near 3.1. And consensus, around $300, sits only a few percent above the price. The growth is more than priced. To be clear, this is a hold on the price, not the franchise. The balance sheet is sound, net debt to earnings under 1 times, interest cover above 15, and the aerospace upcycle is genuine. Because the growth is exceptional and proven, an exceptional growth carve-out keeps Howmet clear of a do not buy. The valuation ceiling fires only as a caution that caps the signal at hold. But at 62 times, the stock is priced for a flawless, multi-year supercycle. On Q2 day, it ran to a fresh intraday high of $310 and then closed back at $289.72, a rejection at the high. The honest move is patience. Own the quality only if a better entry appears. Balance is the point of a hold, so take both sides. On the upside, the bull case is $355, about 22% above today. If the supercycle keeps accelerating, Boeing and Airbus rate hikes stick, the engine spares wave surges, and the market keeps paying a premium multiple. An existing holder is under no obligation to sell a quality compounder. But the downside dominates from here. The rich 62 times multiple leaves a thin cushion, and Howmet is concentrated in the Boeing and Airbus original equipment cycle. An aero build rate stumble, share loss, or rates staying higher for longer would re-rate the stock from 62 times toward 40. The bear case is $240, roughly 17% below the price, and the full derating tail is deeper still. From here, that mean reversion is a real move, not a wobble, which is exactly why a fresh buyer waits. Now weigh the risk against the reward. The bull case is roughly 23% above today, the base case, the most likely, about 9%, and the bear case a fall of about 17%, so you are risking about 17 to make 23. So, our call on Howmet Aerospace on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by HWM Investment at HWM.ca. The link to the full report is in the notes below. Have a great day.